If you think there is a hard cap on the number of residential rental properties you can own in Canada because you wouldn't be able to get financing as you grow, you have been fed one of the biggest lies about financing residential properties in Canada. My team and I have helped thousands of investors across Canada break through the financing ceiling and grow their rental property portfolio from 2 rental properties to north of 40 residential properties. The hard truth is that every lender has a limit, and at some point, every lender is going to say no to you. However, there is a workaround and there is a path and there are strategies that will help you keep going. And in this video, if you stick around with me, I am going to show you what that path is, and I will show you how to continue to scale your portfolio to the levels you envision. What does the residential rental property financing path look like? Well, on this path, you can finance rental properties that have 1 to 4 units. And in some cases, you can finance rental properties that have 5 and 6 units. Here's what you need to know about this path. Number one, on this path, you're going to meet the following groups of lenders. The first group is called the A lenders. These are the banks that will offer you the best cost of money. The next group is called alternative lenders. This is the next group of lenders that will finance rental properties here in Canada, but they do things that the banks don't typically do. For example, if you're a self-employed client and you are not paying yourself enough from the business, these guys would be happy to work with you. If you have a large portfolio, these guys would also be happy to work with you. They're a little bit more expensive than the banks though. And then the third group is the credit unions. And the credit unions, I would categorize them as somewhere in between this group A and the alternative lenders. They also have great options on rental properties. Now, we're not going to get into the specifics of what each of these lenders will do because we're going to talk about how they look at deals in general very, very shortly. But what I want you to know is that on this path, there are 8 turns and twists. If you're going to drive down this path to finance rental properties in Canada, you need to be aware of these 8 turns and twists. And the more proactive you are in terms of how you manage these 8 turns and twists, you're going to avoid what's called the financing wall. You're going to avoid hitting the financing wall. The financing wall is when the lenders say, you need to put a higher down payment. Or, no, I'm sorry, I cannot do more deals for you. You have to go somewhere else. Or they're charging you higher costs, higher fees in order to get the deal done. So if you learn the 8 turns and twists and you know how to manage them proactively, you will be better equipped to maneuver and navigate, and you'll be able to finance up to 40 properties amongst this group. And sometimes actually you can go a bit more. Now, this path is your best path for the cost of money. This is the path that will save you money. We're not talking about private money here. You're talking about buying a rental property with 20% down, 30-year amortization, reasonable interest rate. In some cases, as I mentioned with the alternative lenders, there are some extra fees, but for real estate investors, if the numbers work and your portfolio continues to scale, then alternative lenders are a great option. So let's talk about these 8 turns and twists. What are they and how do you proactively manage them to stretch your portfolio as far as possible with this group of lenders that will save you money? These are the 8 turns and twists that you need to be aware of as a real estate investor when you are financing your residential income property. The more you understand these turns and twists and the more equipped you are and proactive you are in managing them, the higher the chances you're going to get a yes from the lender. And the higher the chances you will get the best cost of money for financing your deal and stretching your real estate portfolio. So let's take a look at each of those, and I will share with you tips on how to manage them and proactively prepare. The first one is your personal credit. This is about your credit score. This is about the content of the credit report, as well as the utilization on your credit cards and secured lines of credits and unsecured lines of credit. The second one is about your personal income, which is how much income are you personally earning outside of the rental properties income and outside of the rental income of any other properties that you have to qualify for the mortgage you are requesting. The third one is about the down payment and where it's coming from. How much down payment do you have and where is that money coming from? Is that money coming from the savings account? Is it coming from an investment account? Is it coming from a secured line of credit? Is it coming from a gift? Is it coming from a second mortgage? That's what this one is about. The fourth one is about the deal structure, which is about how are you going to hold title of the rental property? Are you going to hold it in your personal name? Are you going to hold it in a holding company? Is there, an operating company involved? And are there other people that are coming together with you to buy this property? That's all about the title structure. The fifth turn and twist is about the rental income you are actually going to receive from the rental property that you're buying. Are you looking to assume an existing tenant? Are you looking to rent it? And what type of rental are you expecting? Are you expecting long-term rental? Are you expecting short-term rental like Airbnb? Are you expecting to rent it by room on a student rental? Will that property be rented at the time you close it? All of these things have to be taken into consideration with respect to rental income. This one as well refers to the rental income you receive from other properties that you own. Are you reporting that rental income in a corporation, or are you reporting in your personal name? Are your leases up to date? We're going to dig deep into the specifics of this one. Net worth. This one refers to your fallback. That's what lenders like to see. They like to see that you have a backup plan, that you're not putting every single dollar in a property. So this one refers to any cash or any reserves that you have outside of the down payment that you are using to purchase a rental property. The property condition is the seventh turn and twist. As much as your residential approval is dependent on a lot of these other factors, the property itself is a big portion of the approval. And we're going to talk about its condition and why that matters. The last turn and twist is about the size of your real estate portfolio. Every lender has a limit on how many properties they will finance for you, but also how many properties they would work with. So some lenders will just say, if your portfolio is this big, even though the numbers work, I am not going to work with you. So how do you plan proactively and strategically around each of these turns and twists? That's what I'm going to share with you in the next video. Your credit score and credit report are super important when it comes to getting approved for a mortgage for a rental property in Canada. So I would like to share with you what's important from a lender standpoint and also give you some tips and strategies to stay on top of your credit and to be proactive in doing so you don't get surprised when the time comes to apply for a mortgage. So from a credit standpoint, the lenders will look at two things. One, they're going to look at your credit score, and they're going to look at the content of your credit report. When it comes to the score, whether you're going to a bank or you're going to a credit union or you're going to an alternative lender, they want to make sure that your credit score meets what they're looking for. So for banks, for example, they are looking for a minimum credit score of 650. Now, if you have a credit score below 650, I don't want you to get discouraged, because there are options out there for you. In fact, we finance rental properties with credit scores as low as 500. And the idea here is to go to a lender that works with that credit score and then help you turn it around, let's say over a period of 6 months or 12 months, to be able to get you a cheaper loan once the credit score increases. Now, if you're on top of your credit, sometimes you would have enough runway to improve it before you go apply for a loan. For us as mortgage advisors, we can guide you and let you know that, maybe you are 10 points below where you need to be, knowing that you want to purchase a home or purchase a rental. And here are the things that you can do in the next month, in the next 6 months, to help improve your credit score. That could be paying down certain things. That could be making sure you've tackled a collection that is showing on your credit and things like that. So credit score is super important. But as important is the content of your credit report, because here is what the lenders look for beyond just the score. They will look, number one, at what's called utilization. And utilization is how much you've used out of the credit tools available to you. Let's look at an example. Let's say you have a credit card with a limit of $10,000. And let's say you have used $7,000 of that $10,000. So in this example, utilization is 70%. So the lenders will look at how much you've used out of your unsecured cards, out of your credit cards, out of your secured line of credits, and so on. That's what's called utilization. And you want to stay below this 70% if you can. So I understand, as real estate investors, we use these credit facilities sometimes to renovate properties, to cover unexpected expenses that may come up, to pay contractors, to tie down a deal. Completely get it. And there will be times where you are above this 70%. All I'm saying is consciously keep this number in mind. And if you see that you exceed the 70% and you've got dollars to pay down something, try to bring down the utilization below that 70% within 30 days if you can, or as soon as you can, because the higher the utilization, the higher it goes above this 70%, the more pressure it puts on your credit score. All right. Now, there will be times where, like I said, as a real estate investor, you're sitting at a high utilization because you've used that money towards something in your property portfolio. We can go to the lender and explain why that is the case. Maybe you've just finished a renovation and you're looking to pay yourself back. And through the refinance, we can bring down the utilization. And once we do so, that will help push your credit score up. So utilization is super important. The second one is related to the payment on time. So you really want to make your payments on time within the 30 days. You don't want to miss these payments, and you want to avoid a situation where you're missing a payment on a mortgage, because if a lender looks at your credit report and sees that you've missed a payment on a mortgage that is reporting on your credit, that is a lot more significant and major compared to missing a payment on, let's say, a credit card. So stay on top of your payments. One key tip is to automate payments. This way, you don't have to remember to make these payments. So that is super important. So utilization, paying on time. And the third one is related to collections. I had a client that did not stay on top of their credit. Great client. And at the time of applying for a mortgage to purchase a property, they learned that there was an outstanding utility bill on their credit report. They were shocked. But things happen, Sometimes someone, doesn't pick up the mail or misses a deadline for whatever reason, and the bill goes to collection. You don't want to learn about that in the midst of a deal, all right? But collections are another element that will determine the score, and you don't want to learn about that in the midst of a deal. So in terms of general tips or key tips for you, I recommend that you register for a credit reporting service like Equifax. That would be a lot more accurate than relying on some of the other capabilities, online capabilities for updating you on credit. And yes, it's going to cost you some money, but it's going to be well worth the investment to stay on top of your credit, let's say every quarter or every 6 months. You want to see what's showing up on your credit report. You don't want to learn about these things in the midst of a deal. And just pay attention to these 3 things: utilization, making payments on time, and any collections. Your credit score, your credit report can make or break a deal, can actually switch your deal from a great mortgage into a more expensive mortgage. So I invite you to stay on top of it and to manage it proactively. There are 2 more tips that I want to share with you with respect to your credit. The first tip is about the number of hits on your credit report. You really want to avoid a situation where you've got multiple lenders pulling credit within a close window to each other, or multiple mortgage brokers pulling credit within a short time period, because that is not going to help your credit score. So you want to be, number 1, very particular about who's pulling your credit, and make sure that you've provided them either with a verbal or a written authorization to do so. When a mortgage broker pulls a credit, that hit is considered a soft hit versus when a lender pulls a credit. What does that mean? A soft hit is going to impact your score, but not to the same extent a lender does, because when a lender pulls credit, it does tell the credit bureau that you're seriously looking for money. But be careful about how you shop a deal. You don't really want to go and talk to multiple lenders at the same time, or multiple brokers at the same time, and have them all pull credit on you. You want to speak with a qualified mortgage advisor that you choose. And yes, they're going to have to pull credit within your consent, and then they can use that credit to place your file with the lender. So credit hits are super, super important. Hey everyone, we're going to be going back to the video shortly. I just wanted to bring up this tool, the financing roadmap, which you would have heard me talk about many times, and which has helped thousands of real estate investors across Canada scale their portfolios from 2 rental properties to over 40 residential properties outside of their commercial and land deals and apartment building deals. The financing roadmap is an exclusive framework that all of our advisors at Streetwise Mortgages use with clients to help them plan where the money is going to come from, how to structure the money, how to scale the portfolio using the best cost of money, and avoid the costly mistakes. This is absolutely complimentary if you're looking to build a real estate portfolio, whether you're starting out or whether you feel stuck or looking to scale up. Reach out to us at info@streetwisemortgages.com and get your financing roadmap today. The second tip that I want to share with you is about the type of cards that you carry in your wallet to help strengthen and build your credit. When you're carrying credit cards from major institutions like the banks, these cards have more weight than the weight a retail card would carry. So I invite you to carry 2 credit cards from major institutions and to use these cards and to pay them on time. And that will help build up a good story on your credit report. So these are the 2 key tips that I wanted to share with you. In order to get a mortgage for a residential property in Canada, you have to qualify with your personal income. So let's set the stage. What's a residential property? What's considered a residential property is a property with 1, 2, 3, or 4 units that is zoned residential. And in very few cases, some lenders would consider a 5 units property or a 6 units property a residential as well, but that's not the majority of the lenders. But anytime you apply for a mortgage for any of these properties, be it your residence or your second home, or a recreational property like your cottage or a rental property, you have to qualify with your personal income, regardless of whether you're holding it under your personal name or you're holding it in a corporation. Yes, even if you hold it in a corporation, you have to qualify with your personal income. So in this video, I want to share with you what the lenders look for and give you some tips on how to plan your income. There are several categories of income that we're going to talk about. The first category is an employee. The second category is self-employed. The third category is if you're retired. And the fourth category is other income that you may be earning. So if you're an employee and you've got your pay stubs, you've got bonuses from time to time, that's really pretty straightforward. The lenders are looking for a proof that you're getting paid. Sometimes they want to see the stubs being deposited into your bank account, and not every lender requires a letter of employment. So by speaking with your mortgage advisor, they can let you know if the lender is going to require a letter of employment or not. Not every lender does. If you're employed with seasonal income, where you're working during certain times of the year, but not the entire year, but you do have subsidy through a union, we can work with that income. If you have fluctuating hours, right, the lenders would want to see 2 years of that income in order to work with a number that they would consider stable, okay? But regardless of your income situation, there is a way to get the deal done. It may not be with a bank initially, it may be with an alternative lender or with a credit union, but the best thing you can do is to sit down with a mortgage advisor and to discuss not just how much you make, but how do you earn your income, and let them review ahead of time the documentation needed to support that income. You don't want to just fill in a mortgage application and say that you make $100,000. You want to obviously say what you make, but you want to show ahead of time the documents to support what you're making. And that is a very key point for planning purposes. If you're a self-employed client, I've got some good news for you, because here's the thing with self-employment income. Let's say you are a sole proprietorship, or you may have a corporation and you pay yourself from the corporation. If you're looking to get a mortgage from a bank, well, what will the banks do? The banks would want to see that you have paid yourself enough money from your business for a period of 2 years to qualify for the mortgage. They want to see that. And they also want to make sure that you don't owe any taxes to Revenue Canada. Some of the banks or some of the lenders on the street have special programs where they will take some income from your corporation and add it to your personal income. And that's a beautiful program because that allows you to qualify for a bigger loan. Now, that's what the banks do. The alternative lenders have more flexibility when it comes to income if you're self-employed. They basically have programs where they would look into your deposits into your business account, and they would want to know what your expenses look like, and that's what they would go by. It's called the Stated Income Program. And under that program, they're not looking for your tax returns, they're not looking for the 2 years, so that gives you options. And some of the credit unions also have programs like that. Now, here's an important thing to do if you're a self-employed client. If you're looking to purchase 1 property, 2 properties, 3 properties, it does not matter. You want to plan your income. You want to engage your mortgage broker in a conversation with your accountant and yourself. Why? Because let's say you want to buy 2 properties this year, and your mortgage broker says you're going to need to show that you've paid yourself from your business this much income in order to qualify with a bank. Now, what you want to do is you want to bring in your accountant and have this conversation about how can you pay yourself from the business this amount of money and what will the tax implications be. That's one path to get mortgages with the banks. But maybe the conversation is, you know what, I am not going to pay myself this much on the personal side. I'm just going to keep my money in the business. And I would like to discuss what would my financing look like if that's the case. But at least you're going into the year with a good understanding of the pros and cons. How are you going to show your income? Are you going to get a bank mortgage? Are you going to get an alternative mortgage? You don't want to go and file your taxes and then take that after you file and have that conversation, because when that happens, your mortgage broker or lender will just have to figure out if the deal fits or not. But when you are in the driver's seat, you can control how much you're going to pay yourself, how are you going to pay yourself, and that opens up possibilities for you. This is super, super important for self-employed clients. If you are retired and you're receiving pension income, the lenders will use that income. If you're receiving income from a RIF, registered accounts, they will use a percentage of it. We just need to see how much of that we can use to help qualify the deal. There are other sources of incomes that the lenders will consider. So you may be getting a child tax credit. Not all lenders would use that, but a good mortgage broker would want to leave no stones unturned for you. You may not remember all of these details, but a good mortgage broker will ask you questions to say, okay, is there anything else you want to tell me about your income? Do you have kids? Are you getting this tax credit? They will leave stones unturned. So if you're receiving a child tax credit, some lenders will use it. If you're receiving investment income, let's say you're investing in a stock portfolio and you're getting dividends, can the lender use that income? Yes, the banks will use that income if you are reporting it on your tax returns for 2 years. Remember, the banks are looking for stability. The alternative lenders and the credit unions will work with this on a case-by-case basis, okay? But again, this is why it's super important to have a conversation ahead of time about the sources of your income and how you're going to report your income with your mortgage broker. This way, you are in the driver's seat and you know exactly what type of mortgage you're going to get when the time comes. You don't want to be reactive with that conversation. But personal income is a huge component of qualifying for a residential mortgage in Canada. And here's an important tip for you. Please keep your down payment boring. What do I mean by that? The less sources of down payment, the cleaner your account, the more organized you are, the boring you make it, the smoother it will go. But the more sources of down payment you add, the more movement of money that goes around your bank accounts. Again, not that there is anything wrong with it, the more complicated your down payment story is going to be, and the more complicated and time-consuming your file is going to be. So keep your down payment boring. Deal structure is super important when it comes to financing your residential rental property. But what is deal structure? It is really about how you are going to hold title of the property you are looking to purchase, or how you are currently holding title of the property you're looking to finance. So are you holding title in your personal name? Are you holding title in a holding company? Are you going to hold title in an operating company? Is it just you? Is it you and a spouse? Is it you and a spouse and another group of people, like your joint venture partners? How we structure title is going to have a huge impact on, one, the type of lender your deal is going to get approved with, and two, the type of mortgage you're going to be able to get. Let me just demonstrate my point through a simple example. Let's say you and your spouse have a home and you are also bringing in joint venture partners to the deal who have a primary residence. And you have a good credit score, but one of the folks that you're bringing to the deal has a bruised credit score. What happens when you combine the resources of everybody to buy the rental property that you want to buy together is that the lenders are going to look at not just the combined income of the group, they're going to look at the combined credit of the group, they're going to look at the mortgages that they hold on other properties, and this could enhance the deal or it could actually make things worse. So if one of the people on the deal, for example, has a credit score below what the lender wants to see, then that deal could get canceled altogether. It may not fit with that lender just because of one person. So it is super important if you are planning on buying rental properties with a group is to have a mortgage broker who specializes in income property financing take a look at everything for every individual, their debts, their income, their credit, their property holdings, and to help advise you on how to best structure the deal. Because you don't want to assume that by combining everyone's income, you're in a better off position, because you may not. So that is something now related to deal structure. Same thing for a corporation. Not all lenders do loans under a holding company on a rental property. Many lenders do, but not all of them do. And we always want to think ahead of time on where your deal fits best, because from a big picture standpoint, yes, we want to finance the deal that you currently have and we want to get you the best cost of money, but we also want to take into consideration where you're going with your portfolio. And are we financing the deal with the right lender right now, given where you're headed down the road, or are we just trying to fit a deal to get a mortgage right now, which is the wrong approach to finance? Holding companies will play a role in terms of, the path you would take. So again, we have to understand what type of entity is closing the mortgage and plan ahead of time on how to structure the deal. Some investors make a mistake here when it comes to operating companies. A lot of lenders don't want to see that you have a business that is also buying a rental property. A business can buy a property that it's gonna operate out of, but many lenders like to see real estate held in a holding company that is separate from a business that you're operating. So you don't want to be caught by surprise, assuming that, oh, I have my company and I'm going to buy rental properties there. No, you want to separate your operating company from your holding company. I'm going to share an example of something that happens that clients sometimes learn about by surprise if they don't plan deal structure ahead of time. Let's go back to this example here where a group is coming together to purchase a property. Let's say that you and your spouse want to, down the road, purchase something on your own. You don't want to involve this other couple going forward. You bought one thing with them, but you want to go and buy your own thing, which will happen. You're not going to buy every single deal with a group. I want to share with you how the lenders are going to look at the deal structure and how it can adversely impact what you're going to do down the road if this is not tackled properly early on. So let's say you guys went and bought this rental and it's renting for $2,000 a month, and you are paying a mortgage payment on this property of $1,500 a month. Okay, I'm just using some rough numbers here. And, let's say this property is cash flow. Now it's your turn to go and buy your own rental on your own. When the time comes, some lenders are going to say, okay, you have this joint property with another couple. We are going to just use half of the rents because half of the rents is yours, but we're going to account for the full mortgage payment on your own application. What does that do to your personal deal? That essentially makes the numbers a lot tighter on your own personal deal because the lender is taking a percentage of the rental income, but they're taking the full mortgage payment on this other property that you own with this other couple. My point here is deal structuring is super important in one, helping you get the best financing for your current deal, and two, for keeping that borrowing power open for you if you want to grow. So it's really important to sit down with a mortgage broker who specializes in income property financing and talk about what's going through your mind. What do you want to do? Who's coming to the deal? Validate your assumptions. Don't assume that you can do this and can do that and this and continue to grow. You don't want to learn the hard way. It's all a numbers game. When it comes to residential income financing, it's all a numbers game. And when you are on the outside of the lending rules and all you see in the market is interest rates and you don't see how the lenders think behind the scene, it is really hard for you to figure out what's the best way to structure a deal to make sure that it works, but down the road you can continue to scale. This is where good advice is super important and is one of your best investments, is to get the right advice on how to structure financing for your income properties and what is the best deal structure given where you are right now and where you're headed.